It's October 2008, and you're sitting in a quiet office on the top floor of a financial building in New York. The screens in front of you are glowing red, markets are collapsing, news anchors are speaking in urgent tones. Outside, people are rushing through the streets, anxious, uncertain, checking their phones for updates. For most, this moment feels like chaos, like something is breaking. But inside this room, something very different is happening. There's no panic. No rushed decisions, just quiet focus. Because while the world is selling, a small group of people is buying. This is one of the biggest secrets in finance. Market crashes don't destroy wealth, they transfer it. And during these moments, the gap between those who understand the system and those who don't becomes painfully clear. While the majority reacts emotionally, the wealthy act strategically. They don't see falling prices as danger, they see them as discounts, opportunities, entry points into assets that were once out of reach. The first thing rich people buy during market crashes is undervalued stocks. Not just any stocks, but high-quality companies that are temporarily mispriced. During a crash, fear spreads quickly, and investors begin selling everything indiscriminately. Strong companies with solid fundamentals get dragged down along with weak ones. But this is where opportunity hides. Wealthy investors look for businesses with strong balance sheets, consistent cash flow, and long-term potential. When these companies become cheaper due to panic selling, they step in, because they understand something most people don't. The price is what you pay, but value is what you get. The second thing they buy is entire businesses or significant ownership in them. During economic downturns, many businesses struggle with cash flow, declining demand, or operational challenges. Some owners are forced to sell, often at a fraction of their true value. For someone without capital, this looks like risk, but for the wealthy, it's a chance to acquire income-generating assets at a discount. They're not just buying stocks, they're buying control, influence, and future revenue streams. The third thing rich people buy is real estate, but not at the peak when everyone else is excited. They wait for moments of distress, when property prices fall, when sellers are motivated, when financing becomes difficult for the average buyer. During crashes, real estate markets often slow down, creating opportunities to negotiate better deals. Wealthy investors with liquidity can step in, purchase valuable properties at lower prices, and hold them until the market recovers. Over time, these assets not only regain value, but often surpass their previous highs. The fourth thing they invest in is debt, specifically distressed debt. This is something most people never even think about. When companies or individuals struggle financially, their debt often gets sold at a discount. Wealthy investors buy this debt, sometimes gaining the ability to earn high returns or even take control of underlying assets if the borrower defaults. It's a more complex strategy, but it highlights an important point. In a crash, opportunity exists in places most people don't even look. The fifth and perhaps most overlooked thing rich people buy is time. While everyone else is glued to the news, reacting to every market movement, the wealthy step back. They slow down. They think long-term. They understand that crashes are temporary, but the decisions made during them can have permanent effects. Instead of rushing, they use this time to analyze, plan, and position themselves for the future. Because in investing, patience is not just a virtue, it's an advantage. Now here's what makes all of this so powerful. None of these opportunities are hidden. They're visible to everyone. You can see stock prices falling. You can see businesses struggling. You can see properties being listed at lower prices. The difference is not access, it's mindset. Most people are conditioned to avoid uncertainty, to protect what they have, to wait until things feel safe again. But by the time the market feels safe, the opportunity is already gone. This is why preparation matters more than prediction. The wealthy don't try to perfectly time the market. They prepare for moments when the market gives them an advantage. They build cash reserves. They educate themselves. They develop the discipline to act when others hesitate. So when a crash happens, they're not surprised, they're ready. Think about the pattern. Every major market crash in history has been followed by a recovery. Sometimes it takes months, sometimes years, but over time, markets stabilize, businesses adapt, and growth returns. The people who bought during the fear phase are the ones who benefit the most from the recovery phase, not because they were lucky, but because they were willing to act when it was uncomfortable.
Now imagine the next time a crash happens. The headlines are negative, people around you are worried, prices are falling again. But instead of panic, you feel something different: clarity. You understand what's happening. You've seen this pattern before. And instead of asking, how do I avoid losses, you start asking a different question: where is the opportunity? Because in the end, market crashes are not just tests of financial strength, they are tests of mindset. They reveal who is reacting and who is thinking, who is following the crowd and who is positioning ahead of it.
And the real question is simple. When the next crash comes, will you be selling with the crowd or buying with the few who truly understand the game?